The stock market, in simple terms, is a market where securities are bought and sold. Stocks, bonds, shares of ETFs. The stock exchange operates as a mechanism through which securities are traded and stock market participants interact. How the stock market works. We will talk about the U.S. stock market, which has a long history and represents the world's largest securities market. The American exchanges NYSE and NASDAQ are the largest in terms of capitalization and the most attractive for investors. Americans are introduced to such concepts as the stock market and the stock exchange from the school bench. Shares in the United States are owned not only by millionaires, but by many ordinary citizens. By choosing to invest in shares or other securities, the investor receives a number of advantages compared to earnings from a bank deposit or private business. This article will help you understand what the stock market and its participants are like and how it works. The stock market can be explained as a mechanism for attracting investments to the budget of a public company or country, which allows you to trade in securities, earning on the stock exchange, together with the financial and credit market. The stock market plays an important role in the global economy, providing opportunities for the development of infrastructure and the well-being of the population. Stock market participants. Companies enter stock exchanges to sell shares, bonds on the market and raise money for development. Governments issue bonds to attract investment in the country's economy. Private investors choose to invest in stocks or bonds as a way to earn money. Brokers are obligatory intermediaries between investors and the exchange. The exchange provides a trading mechanism through dealers, underwriters. There are also depositories and other participants. Institutional investors are legal entities that trade in large blocks of shares and provide most of the trading on the exchange. These include investment funds, pension funds, financial and insurance organizations, banks, and credit unions. In addition to the rules in force on the direct stock exchange, such an activity as the sale, purchase of securities is regulated by the state authorities of each particular country. In the U.S., this is the Securities and Exchange Commission. There are also such concepts as primary, secondary, and over-the-counter stock market, which is clearly shown in the diagram below. What is a stock exchange? The first in world history were European exchanges that started their activities in the format of buying and selling goods. With the development of international trade, industry, railways, and banks, the securities market began to grow. Among the most famous stock exchanges were Amsterdam and London, where transactions with securities were made back in the distant 17th century. Through the issuance of bills and bonds, industrial companies and banks attracted investments for their development, and wealthy citizens and entrepreneurs received an alternative to the bank, the opportunity to deposit their funds. The building of the London Stock Exchange was built in 1801, where noisy brokers moved from a small cafe on Change Alley, Jonathan's, where they carried out transactions and mutual settlements. The New York Stock Exchange was founded in 1817 and has a history similar to London's, as it also grew out of business meetings at the Tontine Coffee House. Today, almost two-thirds of transactions related to the stock market take place on the New York Stock Exchange. Wall Street in New York, where it is located, is associated with the World Financial Center. The second largest stock exchange, NASDAQ, was created already in 1971 as a completely electronic exchange without a physical building. In contrast to the old practices of screaming brokers accepting orders to buy and sell by phone from investors, which we are used to seeing in the movies about Wall Street, the activities of modern exchanges have been completely transferred to an electronic format. All participants interact with each other through keystrokes, and the work of employees at the NYSE is visually more similar to the work of a regular office. Today, the work of all modern stock exchanges is organized electronically, and trading takes place online through special trading programs. Given the huge number of participants in trading processes, exchanges use ECN electronic systems, which allow you to automate the implementation of purchase and sale transactions. Simply put, the processes of accepting and executing purchase, sale orders on the exchange occur thanks to ECN, in accordance with the receipt queue. During the COVID-19 pandemic in March 2020, the NYSE Exchange, which has its own trading floor, had to temporarily close it due to quarantine measures, switching completely to electronic trading. Although at that time about 18% of the total trading volume was on the physical trading floor. The stock exchange today is an organization with many divisions, each of which performs its own functions for organizing the trading process, making deals, keeping records, etc. Summarizing, we can give the following definition. A stock exchange is a legal entity that performs a number of functions for organizing the process of the initial sale of securities and subsequent trading in securities on the exchange. Each stock exchange has established rules and standards of work, as well established methods of control and information notification, gives certain guarantees to bidders, performs dispute resolution functions. Regulatory function of the exchange. Since the exchange activities are licensed and regulated by the state, the exchanges are entrusted not only with the functions of the organizer of trading, but also with some regulatory functions. For example, the exchange is required to monitor the market in order to prevent price manipulation, securities fraud, and violations of the rules of brokering. The exchange earns by charging a commission from bidders, listing fees, introductory, annual, and target fees of members of the exchange, and so on. Commissions and fees vary from exchange to exchange. For example, the cost of an IPO on the NASDAQ is cheaper than on the NYSE. The stock exchange is divided into divisions, each of which performs its own functions. Trading division, represented by market makers or specialists, depending on the exchange. Market makers work for the NASDAQ, specialists for the NYSE. As a rule, in both cases, these are legal entities. They are, figuratively speaking, fighters of the first line on the stock exchange. Although the principle of their work is different, they both perform such a basic function of the exchange as publishing orders to buy and sell. Each such application is processed through electronic systems. There are 7 specialist firms on the New York Stock Exchange, while the NASDAQ has over 300 stock market makers. Each security on the NYSE is assigned to one specialist firm. On the NASDAQ, each share is handled by an average of 14 market maker firms, which provide liquidity and efficient trading of shares. Liquidity is the ability to quickly and without significant overhead costs to sell or buy a security in sufficient quantity. Ensuring liquidity is another key task for professionals and market makers, who must maintain the flow, flexibility, and efficiency of trading, creating the conditions for fair trading and an orderly market. To provide this liquidity, specialists and market makers have to maintain the market balance of supply and demand for a particular share. In cases of imbalance, the specialist must make an adjustment by trading shares from his own reserve to balance the market. If the market is flooded with a wave of continuous buying, the specialist sells shares from his reserves until the price stabilizes, and also buys shares in case of large sales. The market maker constantly maintains two-way quotes when trading shares, simultaneously placing orders to buy and sell shares. Thus, market makers and specialists perform similar functions, only in different ways. The differences between them are more related to the rules of the exchanges themselves. Clearinghouse represents the executors of the transaction. These are intermediary firms on the stock exchange, which ensure that the application is guaranteed and unmistakably executed on the NYSE and NASDAQ. They are clearing firms. Their functions include keeping records of funds of trading participants, supplying money for each transaction to sellers of securities, and, accordingly, debiting funds from buyers' accounts, as well as making external and internal money transfers. The clearinghouse guarantees that the investor who sells the shares will actually receive the money, and the investor who buys them really has the required amount in the account. The depository is another important component of any exchange. While the clearinghouse provides and controls the financial side of transactions, the depository delivers securities to the buyer's account and, accordingly, debits them from the seller's accounts. The depository keeps records of securities of trading participants, keeping them in accounts in the same way as banks keep clients' money in accounts. Shares are stored and transferred electronically. Sometimes in the stock market, emotions rage, and the price of a share or shares can jump or fall a lot against the backdrop of massive buying or selling. In some such cases, exchanges use such a mechanism as a temporary suspension of trading. This cools off the heat, gives investors time to make a balanced assessment, and maintains a balance in the market,